our radar.
Okay, all right. Well, let's move on then and let's address Anand Rathi Wealth. Well, they saw a steady growth in the third quarter, seeing growth in assets under management, although the client addition was a little bit slower than what we saw in the previous quarter. But to understand these numbers in a better manner, we're joined by Feroze Aziz, the Deputy CEO of Anand Rathi Wealth, who's now joining us. Hi, Feroze. Always good speaking to you. Wishing you and the team first a very, very good year ahead. That's 2023. Well, let's talk about business. You know, I have your revenue breakup, MLD revenues, but I would like to know what was the MLD issuances for the past quarter, because you'll be getting a percentage on that. So for the past quarter, what was that? And if we could split it up between primary and secondary as well. Go ahead.
Yes, Nigel. Good morning and Happy New Year to you as well. It's always a pleasure talking to you. When it comes to MLD business, we are looking at a total primary issuance or distribution of 1,151 crores, and secondary is about 277. The primary business is a very consistent business because a lot of maturities come. We've been doing the MLD business from November 2012, which is 10-year plus running. So there are maturities of the previous series which come. So you have a consistent 350 kind of crores plus or minus 20-25 crores every month. And that's where you have 1,151 and 277 for the answer for the pointed question you asked, Nigel.
Right. And, you know, your net client addition, as you were pointing out earlier as well, that's decreased a tad from, what, close to around 395 in the first quarter to 451 in the second quarter. Now it's come down to 274. Is there a concern for worry? Was there anything specific in this quarter? Going forward, what is the expected run rate?
Yes. So, Mangalam, when you look at client addition, we generally have a very clear practice of counting clients on the market value basis. When markets go up and down, there are some which go below the threshold. Is why quarter on quarter seeing this number will be a little volatile, because we don't count all clients. We count a client beyond a certain threshold, which is 50 lakhs of assets which are there. And if the market falls beyond a certain point, he or she slips out of our client list, because you don't count a 10 lakh rupee client. Because you're in the business of wealth management for HNIs. That's point one. Point two, if you look at this number of client acquisition on a 9-month basis, which smoothens this volatility because of market movement and portfolio redemption, somebody takes away 5 lakhs and then he is no more a client from the accounting practice perspective. So if you look at the same period, 9 months, 810 for the previous year and 1,100 odd, 1,120 odd for this same period, 9 months.
So this 20-25% sort of growth that you've seen over 9 months is a more sustainable number to look at from a year-on-year perspective for the foreseeable future. Is that correct? Is that the way to look at it? Or will that growth itself come down to 15 to 20 as the base increases?
No, I think growing the client base at 20-25% isn't going to be a challenge, because we are looking at almost about 7-8 lakh HNIs, and we're speaking about 8,000 of them. Getting the next 8,000 is that much more likelier, because this business is a vintage business. If clients have a larger experience and a pleasant one, they refer more clients. So it's a cascading, a nuclear reaction kind of an business. So I don't see any challenge of growing client set for long periods of time at the rates indicated.
All right, Feroze, you said the primary issuances were 277 and the primary was 1150 or 1051?
1151.
1151. All right, we'll just correct that on the screen then. Feroze, you know, I sometimes speak to some of your employees and they seem quite happy. Now the revenues have gone up on a sequential basis, though the employee cost as a percentage has come down a little bit. What's gone on there? Could you explain that to us?
Yes, Nigel. Nigel, since we are running a business which is a wealth management business, which people are compensated on a total comp model, which was developed way back in 2007 June and not modified at all. That's one of the reasons why we have zero regret attrition. Any RM greater than 40 crores, we call them as regret attrition. We have had zero regret attrition in an industry which is normally sees 15-20% attrition, especially in the RM fraternity, because those are the most sought after. So coming back to your point, they are happy. Because it's a total comp. So bonus provisions have gone up to 55 crores for the first 9 months, which if I remember right, for the first 9 months last year was about 46 crores. So that's the reason why fixed comp is not the only variable. It's a total comp, and that gets paid out at the end, and you see larger bonus provisions, which are, if the business does well, and the bonus provision goes up, and people in effect make total comp which is greater than the last year.
Right. Your guidance, the AUM guidance has been raised to 40,000 crores. That still means a 3.5% growth sequentially. Just wanted to understand, because the last couple of quarters you've grown between 7 to 9 odd percent. So is there a bit of a slowdown, and what is the sustainable growth rate out here?
See, our AUM growth rate is going to be 20 to 25% for year on year.
Okay.
Quarter on quarter, because these AUMs have mark-to-market impact. Firstly, our DNA says we have to be conservative. And if the AUM number is a specific 31st March number, we would want to be ultra conservative, because there are some external factors. If the Nifty is down, then the AUM would read down. Because it has the market impact plus the effort put in by all my colleagues and me, I would rather have a conservative number there. And the AUM growth of 20-25% has happened for the last 10 years. It should happen for the next 10 years, because God is kind to a business like ours, because with passage of time, markets move up and clients make 10-12% on their portfolio. We just have to work for the residual 12-15%.
Feroze, give us a broader sense, for your company as well as from the market perspective, how is the customer behavior changing? I'm looking at your mix currently, it's skewed towards equities rather than debt, but the interest rate scenario is rising. So are you seeing a bit of a shift out here? Do you expect that to happen? And are you experiencing any kind of redemptions?
No, Nigel. See, what the 8,200 clients which we are speaking about, whom we deal with, are a homogeneous group of HNIs who have intergenerational wealth. We don't believe in managing corporates, treasuries, who might have a sudden capital expansion. They would take away the money. So these are intergenerational wealths. All the allocations are derived out of their return risk objectives, which are numerically defined. If a person has a 13% return objective, my team finds out what is the least standard deviation at which 13 can be achieved. And if there is a specific allocation on that basis, that's the allocation which most people stick to. So we run only 4 portfolios for 8,200. So my 81-member research team focuses only on 4 portfolios so that they can deliver the best. You can't have 8,000 customized portfolios. So coming back to your pointed question, are we seeing flight of capital from equity to debt? The answer is no, because this is intergenerational wealth. But we are seeing we are catalyzing a large infusion, which should fructify in the next 1 year, from FDs to target maturity funds. Because if you can lend to a government of India and still make a 10% implied pre-tax FD for an HNI who's on the highest tax bracket, there we have seen some traction. We've been able to redeem 500 crores of FDs and moved it to target maturity funds. And that will, I think, catapult into a large net mobilization activity over the next 1 year.
All right, and final question then from my end. Feroze, can you please help with the revenue and profit split of equities and MLDs for you?
See, our trail revenues have gone up about 27%. We target a 50-50. I think we are somewhere around 40-42% coming from trail revenues of mutual funds, and some other incomes of 2-3% from brokerages and other PMSs, which are there residual in the other assets of 12%. So we are targeting to have 50-50. I think we are moving in that direction.
And profitability split?
The profitability split can't be done product-wise, because the product profitability is on the revenue side. So I think I would not be able to split profitability on products. Both the yields are similar. Let me try and answer it this way. The yield which we make post GST on mutual funds, the 11 scheme model portfolio, is 1.11% post GST, and we make 1.17 for the last 10 years. We've made 1.17% on MLD. So the yields for both the products are same.
Similar.
The recognition of accounting could be different.
Good speaking to you as always, Feroze. Thanks so much for stopping by. Wishing you all the best for the coming year as well, and look forward to catching up with you. Well, for the time being though, keep an eye out on the markets. We've seen a good recovery yet again. So it seems the market's going to around that 17,770 and bouncing back up 50-60 points odd. The question is, can it hold on to these levels? And I'll tell you what, there appears there is some shorting at higher levels. If in fact we don't break that 17,770, we could see a big bounce from here on. That's only if we can hold above these levels. So let's see whether that does play out today as well. For the time being, we'll slip into a short break. When you come back, we'll have Manoj Jaiswal, who will be joining in for a technical check on the markets.